Somewhere in your bank account, money is leaving every month and you do not know where it goes. Not all of it. You know the rent. You know the big ones. But there is a gap between what you think you spend and what actually leaves. And that gap is the reason your money never quite behaves the way you expect. Here is the strange part. Most people are already budgeting. Around 3/4 of adults say they have one. And of those people, 84% go over it. Read that again. It is not that people do not budget. It is that budgeting, the way almost everyone is taught to do it, does not work. So in the next 14 minutes, I am going to show you why it fails, which has been studied properly and is far more interesting than you would expect. And then I am going to give you a system that needs no app, no spreadsheet, and about 20 minutes of your life. Total. Forever. You will not need willpower. That is the whole point. One rule on this channel. If a 15-year-old could not follow it, I explained it wrong. So no jargon without a definition, and nothing assumed. If you have never made a budget in your life, you are exactly who this is for. Let's start with why budgets fail, because if you do not understand this, you will just rebuild the same broken thing again. Reason 1. Your budget is not a prediction. It is a wish. Researchers ran a set of studies where they asked people to predict their spending for the coming week. People predicted they would spend substantially less than they actually did. That is not shocking. Here is the shocking part. They also predicted they would spend less than they remembered spending the previous week. Think about that. You have direct evidence of what you spent 7 days ago, and you still predict a lower number for the week ahead. And the researchers found what was driving it. The stronger someone's desire to save, the lower their prediction. But that desire had no relationship whatsoever to what they actually spent. So the wanting affected the forecast and did not affect the behavior at all. When you sit down and write a budget, you are not describing your life. You are describing the person you would like to be. And then that person does not show up. Reason 2, and this one is the biggest killer of all. It is not your coffee. It is the car repair. There is a study on this with a wonderful title. The exception is the rule. Researchers found that people forecast their ordinary expenses reasonably well. Groceries, fuel, the usual. But they systematically underestimate exceptional expenses. The car service, the vet, the wedding gift, the flight for the funeral. And they found the exact reason why, which is the good bit. Every one of those feels like a one-off. A weird month. Not typical. So your brain files each one separately and never adds them together. But when the researchers showed people those same costs grouped as a set rather than one at a time, people suddenly recognized the pattern and were less willing to spend. You have a car repair once a year, a big gift a few times a year, a trip, a dentist, a broken phone. Individually, every single one is an exception. Together, they are a category, and it is a large one. Your budget does not have a coffee problem. Your budget has an exceptions problem, and exceptions are invisible if you only ever look at 1 month. Reason 3. Categories themselves cause the error. Research from the 90s found that people apply a category budget only to purchases that obviously belong in that category. Anything that does not clearly fit gets filed nowhere and escapes the budget entirely. That is why people say the maddening sentence, "I stayed in budget and still ran out of money." The money went somewhere your categories had no name for. More categories does not fix this. It makes it worse, and it makes budgeting slower, which matters, because when people are asked why they do not budget, the top answer is no longer that they do not earn enough. It is that it takes too much time. And reason 4, the one that should honestly change how you think about all self-improvement. A meta-analysis looked at 168 papers on financial education. It found that teaching people about money explained about 0.1% of the variation in what they actually did with it, and the effect had basically vanished after 20 months. 0.1%. Which means, and I want to be honest with you here, watching this video will not change your finances. Knowing things does not change behavior. What changes behavior is what you set up once and then never have to decide about again. So that is what the rest of this is. Not tips. A setup. Before the fix, one more thing you need to see, because it explains a lot of the gap. There is a 2024 meta-analysis of 71 studies across 17 countries. It confirmed that people spend more when paying digitally than when paying with cash. Money that never physically leaves your hand does not feel like it left. In one older auction experiment, bidders told they had to pay by card were willing to pay dramatically more, in that study as much as double, for exactly the same item. Now think about how you actually pay for things. Tapped. Saved card details. One click. Automatically renewed. Which brings us to the quietest leak of all. 2/3 of people have forgotten about at least one recurring payment in the last year. And when researchers asked people to estimate their subscription spending, the share who were wrong, and by a wide margin nearly tripled in 3 years. Money you forgot to agree to keeps leaving on schedule. That is not a discipline failure. That is a design failure. Right. The system. 4 moves. You do the first 2 once. You do the third once. The fourth happens without you. Move 1. Look backwards, not forwards. Do not start by writing what you intend to spend. You now know that number is fiction. Open your bank statements and read what actually happened. And do not read 1 month. That is the mistake everyone makes. Consumer protection agencies say to look back several months specifically so less frequent expenses appear. 1 month hides every annual cost you have. Read a full year if you can bear it. You are not looking for shame. You are looking for surprises. The question is not, where did I waste money? It is what is in here that I did not know about. 2 things fall out of this. Subscriptions you forgot. And the exceptions, all together, for the first time in your life. Move 2, and this is the one that fixes the biggest failure. Budget by the year, then divide. There is a study on how time frame changes the number people write down. Ask what someone will spend in a month. And the estimate lands well below reality. Ask what they will spend in a year, and it comes far closer to the truth. The reason is almost funny. A year is harder to estimate, so people feel less confident, so they revise upward. And upward turns out to be correct. So do this for everything that is not monthly. Take the yearly cost and divide by 12. Car service, divide by 12. Insurance, divide by 12. Every gift and birthday for the whole year added up, divided by 12. Holidays, the dentist. That number is not optional spending. It is a bill that has not arrived yet. Official budget planners published by government money services let you enter any cost as a yearly figure and convert it automatically. The regulators know this is where budgets break. Some people call it a sinking fund. The name does not matter. Doing it is the difference between a budget that survives March and one that does not. Move 3. Separate the money physically. This is where the actual power is, and there is a beautiful piece of research behind it. A study gave low-income households money to save for their children's education. One group got it in a single envelope. The other got exactly the same amount split across 2 envelopes. Same money, same goal, same people. The only difference was the partition. The 2-envelope group saved 72% more. Nothing was added. No advice, no incentive, no reminder. Just a line drawn through the middle of the money. That is how strongly your brain treats separated money as separate. The economist who explained this calls it mental accounting. And the core finding is that money in one mental account is not treated as a substitute for money in another. In theory, all your money is interchangeable. In practice, it is not, and you can use that. So separate it. The simplest version, recommended by National Money Guidance Services, is 3 accounts. 1 account that bills come out of. 1 account you actually spend from day to day. 1 savings account, kept separate. That is it. 3. Your bills account holds your fixed costs plus that divided by 12 number for the exceptions. Your spending account holds what is genuinely free to spend. Your savings account is not for spending. And here is the point of the whole exercise. Once your spending account is separate, you never have to track anything again. You do not need to categorize a purchase or update a spreadsheet. You look at one balance and it tells you the truth, because everything else is already somewhere else. That is budgeting without an app. The accounts do the tracking. Move 4. Automate it on payday and never touch it again. This is the best evidenced idea in the video, and the numbers are striking. A study of workplace retirement plans found that when saving was made automatic instead of something you signed up for, participation was around 50 percentage points higher. The effect was largest for the people usually hardest to reach. Lowest earners up 67 points. Youngest workers up 57. Same people, same salaries, same information. The only change was whether it happened by default. Another program let people commit in advance to saving more out of future pay rises. Their savings rate went from 3.5% to 11.6% over 28 months, and 80% were still in it after 3 pay rises. And my favorite, because of what it rules out. A trial in Chile tested ways to help people save. One group got an automatic monthly transfer into a separate account. They saved around 18% more. Another group got monthly reminder messages. The reminders did nothing, effectively zero. So when someone tells you to set a phone alert and try harder, that has been tested. It does not work. The transfer works. Set the transfers to leave the day you get paid. Savings first, then bills, and whatever is left lands in your spending account. Do not save whatever is left over at the end of the month, because there is never anything left over at the end of the month. Move it before you can see it. 2 honest caveats, because I would rather you trust me than be impressed. The first is that the same research showing defaults work also show. People tend to get stuck at whatever the default is, so set the number slightly higher than feels comfortable, because you will probably leave it there for years. The second is about all those named methods you have heard of. 50-30-20, zero-based budgeting. Cash stuffing. I looked for proper studies comparing them head-to-head, and there are none. Anyone telling you one of them is proven best is telling you a preference, not a finding. What does have real evidence behind it is what we just did. Look back far enough to see the annual costs. Convert them to a monthly number. Separate the money into different accounts. Automate the transfer on payday. See, your money is now doing the boring part without you.